We're here at the NCUA headquarters with the chairman of the NCUA, Debbie Matz, after the February board meeting. First, I want to thank you for taking time to speak with us after this month's board meeting.
Thank you. It's a pleasure to be here.
Now, the rule that was proposed at this meeting, could you talk a little bit about why it's important that this is proposed and what changes it will bring about?
This is a change that modernizes our rule on voluntary liquidations. It's a rule that hadn't been updated since 1993, so it really fits well into our rubric of modernization, regulatory modernization. Basically, it doesn't make many changes. There are not very many credit unions that voluntarily liquidate, but for those that choose to, and we are not advocating that. I want to be clear, we are not encouraging voluntary liquidations, but we get about 2 a year, and it's a very cumbersome thing to do. And so we've streamlined it, made it a little easier for the members to collect their money, and made a few minor changes. But basically, we were just modernizing it so that when they put out a notice, they are required to not just put it in a newspaper, but to let people know by electronic means that they are going to liquidate. So it's just bringing the rule into the 21st century.
And there was also at the meeting the financial report for the Share Insurance Fund presented. Could you talk a little bit about what we've seen in terms of that report and what findings the credit union should know about?
Well, the Share Insurance Fund is very strong. We ended the year at an equity ratio of 1.31%, and we're required by law to maintain the ratio at 1.30%. So any amount above the 1.30% is transferred to the Corporate Stabilization Fund. So at the end of the year, we transferred about $95 million to the Corporate Stabilization Fund, and that will help to reduce any future assessments that might be charged to credit unions.
Now, at the last meeting, the risk-based capital rule was proposed. We're in the middle of the comment period for that. And since then, the trade organization, CUNA, has called for public hearings on the risk-based capital rule. Is that something that you would support?
Well, first I should say that the comment period has not actually started yet because the comment period starts after the rule is posted in the Federal Register, and the Federal Register has not yet posted it yet. So when it is posted, and we hope that it's sooner rather than later, then the 90-day comment period will start. So there's actually been an extended period for credit unions to analyze the rule and start drafting their comments. But every 2 years since I've been here, I've held listening sessions so that I can meet with credit unions and the other board members if they so choose, and hear from credit unions about what issues are on their mind, about what they'd like to see changed, about how we can better communicate. And so we are going to be holding 3 listening sessions, and it will be an opportunity to hear about risk-based capital, amongst other things, really anything that credit unions choose to discuss with us. We'll be holding a meeting on June 26th in San Francisco, on July 10th in Chicago, and July 17th, I believe, in the Washington, D.C. metro area. We'll be putting out announcements so that people can register so that we know how many people are coming. The rooms will probably hold about 150 people, and it'll be on a first-come, first-served basis. But we will be putting out more information. But this is really part of my regular series of listening sessions that I've held every 2 years.
Now, thank you for clarifying the comment period. So the 90-day comment period will begin when it's in the register, so credit unions should look out for that.
Correct, and hopefully it will be any day now. And that's something beyond our control. Whenever the Federal Register publishes it, that's when the comment period starts.
Now, you had a webinar recently with CFPB Director Richard Cordray, and non-QMs were brought up a lot. The QM rule was discussed extensively. Do you think that these rules going into effect could actually hurt the non-QMs being offered at credit unions, meaning some credit unions would just not offer them anymore, those kind of loans?
Well, we're hoping that that's not the case because credit unions are very good at making mortgages and are very good at meeting the needs of their members. And Director Cordray was very clear to credit unions that they should keep doing what they've done in the past. He said, you've been successful, you haven't had problems, and I encourage you to keep doing what you've done in the past. He said that several times. So I'm hopeful that credit unions will take that message to heart and keep making the types of mortgages that they've made in the past.
He mentioned that if their credit unions are going to make any changes to the way they practice lending, they should take into consideration possibly reaching out to the CFPB or NCUA to get more information. So is that the same position that you share?
Oh, absolutely. Our Office of Consumer Protection has put together a great deal of information. We've put out many reg alerts to help synthesize the information, because the information from CFPB is overwhelming. There are hundreds and hundreds of pages of regs to read through. So we have synthesized that information and we've put it out in, I think, probably 7 or 8 reg alerts. But our Office of Consumer Protection is available to answer any questions, and certainly I'm speaking for CFPB, but I know that they are. Mr. Cordray has made it clear that they are available to help to answer any questions. So they can always come here in the first instance, and if they don't feel like we've been able to answer their questions, they can go there. But I feel certain that we'll be able to answer any questions that they have, and if not, we'll get an answer for them.
I also want to ask you about another rule that was proposed in the past, the home-based credit union rule. Have you received comments on that rule, and if so, have they been more in support or against that proposed rule?
We have received comments on the rule, not an overwhelming number of comments, but we have received comments. Only a small number of the comments were actually written by credit unions that will be affected by the rule, which was interesting. We read the comments carefully, and before we finalize the rule, deliberate as to whether to make any changes based on the comments. So we're in the process now of reading the comments and deliberating about what direction to go in.
And do you have a timeline for when you think that might be brought up again and possibly finalized?
I'm anticipating that it will be the first half of this year, but I don't have an exact month.
And another question I have about the diversity standards that the comment period just ended for those. Have you gone over some of those comment letters, and what has been the reaction so far from NCUA?
Well, the comment period ended on February 7th, so I personally haven't had a chance to look them over yet. It's an interagency rule, so all of the federal regulators, the federal financial regulators, will be reviewing all of the comments. I know that there have been quite a few comments. Initially, the greatest concern was that the interested parties, the stakeholders, felt that they needed more time. And so we extended the comment period by 45 days, and that ended on February 7th. One of the things that I'm hearing about is a concern that the diversity standards not be considered as part of the exam. And that has never been a consideration. That will not happen. So I want to allay that fear right now. I know that's a big concern, but that is not the intention.
So it will not be part of the exam, will not be taken into consideration.
It will not be part of the evaluation, of the exam evaluation, no.
The other concern that I read about from the trade organizations, that was one of them. The other one was that it increases manual reporting requirements for credit unions. Do you think that could create a new burden for credit unions going forward?
Well, we always try to make our rules minimally burdensome. This is a rule that is interagency, so we have an opportunity to weigh in on it, of course, as do all the other regulators, but it is not written exclusively from NCUA. So we do try to keep things minimally burdensome. We work with the other regulators on that, but we don't have control over it.